This video provides an overview of the major concepts covered in Chapter 27, Fintech in Financial Markets. The term Fintech, short for financial technology, refers to the cutting-edge products and services that the financial industry offers to supplement or replace more traditional means of providing financial intermediation and services. The rapid advancements in digital technology have fueled the explosive growth of Fintech by enabling companies to provide more innovative products more quickly, more affordably, and more easily than through traditional financial intermediaries. Chapter 27 includes 5 key learning objectives. First, to describe the origins of Fintech. Second, to describe the implementation of blockchain technology. Third, to describe cryptocurrencies and their characteristics. Fourth, to identify the most important Fintech developments in the financial services sector. And fifth, to discuss the regulatory structure of Fintech. Let's start with the origins of Fintech. The origin of financial technology can be traced back to the 19th century invention of the telegraph, which allowed the electronic transfer of money. In the mid-20th century, credit cards were introduced, which allowed holders to make secure payments for goods and services without the need for checks or cash. During the 1980s, computer workstations allowed financial institutions to offer new services, including secure access to bank accounts through telephone lines. Similarly, brokerage firms used telephones to allow customers to access their brokerage accounts and place trades. In the 1990s, the introduction of the internet and faster, more powerful personal computers greatly enhanced the number of services financial institutions could offer. During the 21st century, advances in smartphone technology have led to the development of financial applications, including money transfers, stock trading, and online banking. Cloud computing is allowing fintech companies to develop online applications, offering a wide variety of banking and financial services, such as lending, payments, and investment services. Fintech businesses are now using machine learning and artificial intelligence to provide services that were previously handled by humans, like insurance processing and robo-advising. Now let's look at blockchain technology. Traditionally, database systems were centralized computer storage facilities where data was stored on separate servers. Normally, authorized users only have access to this data with the authority to add, modify, or erase it. This exhibit shows a traditional database system for storing financial information. In this framework, authorized users can access data that's stored on the server in one central location. Blockchain technology is a different form of decentralized, distributed database system where data is shared among several computers on the network, as shown in this exhibit. In this decentralized, distributed system, multiple computers connected to the computer network each store an identical copy of the data. This architecture eliminates the need for a single administrator and distributes maintenance and security management across network users. The name blockchain comes from the way data in the blockchain system is organized into blocks and connected to one another to form a chain. A block consists of 2 parts, a header and a body. The header contains non-transaction information related to the functionality of the blockchain programming. The body is where the record of transactions is stored. For example, a sale of cryptocurrency might contain information about the buyer, the seller, and the amount and time of sale. Many users or nodes on the computer network share and store the ledger. Because copies of the ledger are continuously synchronized, all users always have access to the same data. Key advantages to the blockchain include its decentralized and distributed database system, which makes it extremely difficult for hackers to access and alter the database. In addition, the blockchain is immutable, which means that once the data is written to the ledger and approved by the majority of the nodes, it cannot be removed or altered. This immutability can sometimes be a disadvantage because errors made during the data entry process are very hard to fix. Another disadvantage is the very energy-intensive mining required that uses thousands of decentralized computers from all over the world to record transaction information on blockchain blocks, validate data, and append new blocks to the distributed ledger. The third key concept in the chapter is cryptocurrencies. Cryptocurrencies are digital or virtual currencies built using blockchain algorithms and utilizing encryption techniques to verify fund transfers. Cryptocurrencies operate independently of national governments, thus their legal status depends on the financial regulations of the country in which they're implemented. The financial regulations governing cryptocurrencies vary from nation to nation. Cryptocurrency transactions also provide relative anonymity for the parties engaged in a transaction, and unfortunately, these cryptocurrency features invite illicit activity in the form of money laundering and/or tax evasion. This exhibit illustrates how cryptocurrencies can be roughly categorized into 4 categories based on their intended usage. The first category, which includes bitcoins, is made up of 2 types of cryptocurrencies: ones that can be used to pay for goods and services instead of fiat currency or government-issued money, and 2, ones that are used to store value. The second category consists of cryptocurrencies that are employed in decentralized financial applications to do various tasks. These cryptocurrencies can be utilized for lending, collateralizing assets to generate interest, and other financial functions. The third category consists of tokenized blockchain systems on which smart contracts and other decentralized finance applications can be developed. Users of these services benefit from tokens in a number of ways, including lower fees. The cryptocurrencies known as central bank digital currency, or CBDCs, which are provided by the central banks of several nations, make up the final category. Bitcoins are the most widely used cryptocurrency and the one with the highest value. Established in 2009, Bitcoin is a peer-to-peer payment network owned and controlled by its users. To use Bitcoins in an international transaction, a firm deposits its own local currency into its account at an online Bitcoin exchange or platform. The money is used to purchase Bitcoins, which can either be stored in the owner's digital wallet or sent immediately to a recipient in another country. The recipient then sells the Bitcoins on the online platform for its local currency, withdraws the money from its online account, and deposits the money into its bank account. Alternatively, the recipient could keep the Bitcoins in its digital wallet and use them to conduct other transactions. One major advantage of Bitcoins is the speed of transactions, especially international transactions. In addition, the fees for fund transfers are generally lower than fees charged by financial institutions for international payments. Another potential advantage of Bitcoins is that credit risk is eliminated because the payer must pay up front by depositing full payment at the Bitcoin platform to obtain Bitcoins. In addition, Bitcoin transactions are irreversible, which means the seller is assured of payment. For multinational corporations with subsidiaries in several countries around the world, using Bitcoins for all of its transactions could eliminate or at least reduce the need to maintain accounts in several different currencies. Another advantage is the cap on the quantity of Bitcoins that can be mined or produced. Once the 21 million coin maximum is reached, no more Bitcoins can be mined, in contrast to other asset classes like stocks or bonds that have no such constraints. Disadvantages of Bitcoins include the inability of purchases on credit to manage cash flow. The irreversibility of payment can be a disadvantage if the purchaser isn't satisfied with the products. Bitcoin has been subject to extreme volatility based on supply, demand, speculation, and investor attitudes. On some days, the value of Bitcoin has risen or fallen by 10% or more in just a short period of time. And given this volatility, the value of Bitcoins in a digital wallet could change dramatically in a matter of hours or even minutes. Another problem with retaining a large amount of Bitcoins in an account is that the firm has no protection against loss, and deposit insurance is not available for Bitcoins. The historical price of Bitcoins is displayed in this exhibit, where we can see the value of Bitcoin peaked above $67,000 by November of 2021. However, by February of 2022, it dropped sharply below $38,000, and by December 2022 had fallen below $17,000. By November 2023, however, it increased past $37,000 once more. Although Bitcoins offer several advantages for international transactions and the resulting exposure to exchange rate risk, the lack of protection for Bitcoin owners, and the potential for illegal activity have hindered their use. Overall, it's impossible to predict what the future of Bitcoin will look like. However, the immense popularity of Bitcoins has led to the development of numerous other applications based on blockchain technology, and we can likely expect that innovation to continue. Beyond cryptocurrency payment applications, an increasing number of financial applications have emerged that leverage blockchain technology. Smart contracts are one example. A smart contract is a decentralized digital contract stored on the blockchain that contains the terms of an agreement between two parties to a transaction. The smart contract allows the two parties to automate and execute a transaction without the need for intermediaries. A stablecoin is a cryptocurrency whose value is pegged to another asset, such as a fiat currency, commodity, or digital asset. Theoretically, maintaining an equal amount of reserve asset as collateral would create a one-to-one backing for the stablecoin and allow for price stability. However, stablecoin issuers have rarely maintained adequate reserve amounts to stabilize the value of their cryptocurrencies. Algorithmic stablecoins don't have any asset reserves. Instead, the algorithm sets the balance between supply and demand. The popularity of cryptocurrencies has led central banks to consider offering their own digital currencies. Unlike cryptocurrencies, which have been plagued with numerous security concerns and are generally considered to be speculative types of digital assets, a CBDC is intended to be a secure, digital, and stable medium of exchange. The fourth concept in the chapter relates to fintech innovations in the financial services industry. Banks have long been pioneers in technological investment. Fintech is dramatically changing the manner in which banks and other financial institutions provide financial products and services to customers in the areas of online banking, mobile banking apps, chatbots, and digital wallets. Traditionally, lending has been conducted by financial intermediaries that channel funds from surplus units to deficit units. The financial institutions perform screening, risk assessment, credit assessment, and monitoring functions. Fintech is providing an alternative lending process by providing peer-to-peer or P2P lending, which directly matches lenders with borrowers through an online P2P platform. Technologically advanced computer applications are often employed in the investment management area. High-frequency trading, or HFT, relies on powerful computers and advanced algorithms to continuously buy, sell, or cancel orders over short periods of time to make profit from small price variations. More recently, AI and ML techniques have been used to develop quantitative investment strategies for asset allocation, security selection, trading, and forecasting. In recent years, investors have seen the emergence of robo-advisors, which use algorithm-based investment advice online without any human input or interaction. Robo-advisors assess client financial status and provide advice based on client risk and return profile. They select investment securities and then continuously monitor and adjust client portfolios during market hours. Innovative financial technology used in the insurance industry is called InsurTech, which allows insurance companies to increase efficiency in underwriting and pricing of policies, claim processing, and risk management. The last concept in the chapter is fintech and regulation. Regulating fintech is a very challenging task because fintech companies are essentially technology companies that provide financial services with different modes of operation in geographic locations. Data privacy and cybersecurity issues arise because fintech companies collect large amounts of data that's used to provide financial services, which creates security and privacy concerns because it includes sensitive personal information that can be targeted by hackers. Cybersecurity is a major concern for fintech companies and regulatory agencies. Safeguarding personal data, protecting financial assets, and curbing illegal use of fintech products are the three major issues that regulators are faced with.